My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I'll be one of my friends. I'm just trying to make you some money. My job is not just to entertain you, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. And if you remember Charlie the tuna from those old StarKist ads, you know, the debonair fish with good taste who fancied himself the perfect tuna for StarKist? In every ad, Charlie the tuna got shot down. Sorry, Charlie, because StarKist didn't want tuna with good taste. They wanted tuna that tastes good. I dredged up this 60s gem because today the market rejected Charlie, the tuna with the taste for turbocharged growth stocks, and instead went with tuna that just plain tastes good, meaning solid, clean companies with no real flaws that have newfound consistency. Now, look, if you only looked at the averages, this would have seemed like a sedate day. Dow dipping 23 points, S&P inching down 0.20%, Nasdaq declining 0.30%. Oh, but when you dig deeper, there was a major rotation out of the Charlie the tuna stocks and into plain old albacore packed in water. It all started yesterday when the banks reported much better than expected quarter, especially given that the inverted yield curves crimping their ability to make money off your deposits. Turns out the banks have so many other robust earnings streams that we don't need to fret about the yield curve as much as we once thought. JP Morgan delivered an unbelievably powerful number with impressive growth practically across the board, including an astounding 8% revenue growth. The stock immediately roared from 116 to 121. This is a bank stock, for everything, before closing at just under 120. As CEO Jamie Dimon pointed out, I quote, "The consumer continues to be quite strong," end quote. Hey, gloomers and doomers, listen to Jamie. Citigroup posted a similar excellent quarter, and this market lapped it up, although it gave back some of the gain today. Even Goldman Sachs, which actually missed its projections, was able to tell a good story, and its stock rallied yesterday and today. Goldman put its buyback on hold while they sort out this Malaysian bond scandal, but they're now resuming the repurchase program. Hey, isn't that conviction? Then today, Bank of America printed a huge number with fantastic growth. Their digital business is so good that I almost think of this as a technology company that happens to be in banking. Bank of America has 38 million active digital users, 29 million mobile banking users. Last year, they launched a virtual voice assistant, Erica, and it already has 9 million active users. These are extraordinary numbers, people. They're not just attracting millennials. They're luring in older users, too, or the numbers couldn't be that big. Aren't that many millennials, for heaven's sake? Bank of America tells us the consumer's in good shape. Their consumer banking division saw 7% loan growth, which is part of why I think the earnings have real staying power. Hey, by the way, and the loan losses are very low. How satisfying are these figures? Warren Buffett currently owns 10% of Bank of America, and he's asking the government for permission to buy even more. I'm betting the Oracle of Omaha wish list will be granted, and soon will be in there buying the stock hand over fist. The market embraced these quarterly reports because the banks showed consistent earnings growth when very few people expected them to. They're supposed to be more hostage to the Fed. With their consumer emphasis, the big banks can decouple from the trade wars. Now, I know the Commerce Department just released some ugly retail sales numbers this very morning, down 0.3% in September. But these banks tell a different story. They've become the ideal names for the StarKist-style market. Yep, they're not flashy. They're just tasty. What else? The love extended to the healthcare companies that reported beautiful numbers. Pulcher, too. With stocks that had gotten to deep value levels versus their growth rates, Johnson & Johnson rallied nicely. Investors gushed over its growth, relaxed when management reassured us about all the myriad lawsuits. Hey, look, they're going up against opioid and talc plaintiffs' lawyers. I felt better after the call. United Health exploded higher when it shot the lights out yesterday, even if it ultimately pulled back today. UNH has a habit of delivering terrific results, but lately that hasn't mattered. Because it's a managed care situation in a world where the Democratic frontrunner Elizabeth Warren wants to replace these companies with Medicare for all, a.k.a. single payer. This time, though, fears weren't enough to keep UNH down. Hey, more on that one later. Big Dow stock. Then there are the beaten-down transports. It doesn't take much to catapult a stock that's selling for 7 times earnings. So it made perfect sense when the market fell in love with United Continental after the airline boosted its forecast. There wasn't much pin action to to the rest of the transports, but they did rally somewhat. And then after the close, CSX reported an excellent number, and its stock was advancing in after-hours trading. Now, let's contrast these winners with the high-growth stocks that the market's rejecting. Sorry, Charlie. Sell, sell, sell. First, Cramer fave Workday held an analyst meeting yesterday where they failed to impress. The company's core human capital management division showed slowing growth, something that's unforgivable when your stock sells for over 100 times earnings. I was shocked at not the slowing, but not the reaction. I mean, if they slow at all, the reaction is going to be incredibly negative. This market has no patience for enterprise software companies that can't grow at an aggressive pace. And I've got to tell you, enterprise software didn't do too well for IBM this very evening either. ServiceNow and Adobe both got downgraded today. That surprised me because these two stocks are sainted. I saw nothing in particular that was disconcerting at ServiceNow, other than its expensive valuation. Adobe downgrade zeroed in on some slowing in its Commerce Cloud offerings, which handicapped the company the last time it reported. The negative pin action did extend to Salesforce, even though Salesforce did shoot the lights out when it last reported. We're going to hear from founder, chairman, and co-CEO Mark Benioff later in the show. For now, just know this sell-off is total guilt by association, although there is admittedly some overlap between the substance of the Adobe downgrade and Salesforce. Can the rotation last? I don't think it's permanent. They never are. There's just too much love for growth, too much belief in the future of these companies that are currently being taken to the woodshed. Consider this very evening, deep value, high-yielding IBM that I just mentioned and high-value valued Netflix reported IBM laid an egg. Its stock is being savaged after the bell. While Netflix trumped estimates, it's roaring into tomorrow's session. Still, the high flyers that got hammered today will need to report some terrific quarters before the market's going to forgive them. The good news, there are plenty of senior growth stocks that can still move higher. When Merck reports on October 29th, I bet it'll be terrific thanks to Keytruda. I think CVS, that's Victor Kind, CVS, which owns Aetna, will print a fabulous number at the beginning of November. Not unlike when United Health reported, and the stock is darn cheap here with a 3% yield. I know many of you watched last night's Democratic presidential debate. With elation, if you favor more redistribution of wealth, or with horror, if you favor the status quo. The rhetoric was intense, particularly against the drug companies and the banks. Yet both groups put up some splendid performance today. That doesn't mean they're now immune to politics, though. But the bottom line is that today's winners are immune to the fallout from the trade war. They can create terrific earnings from the consumer or from healthcare businesses that have nothing to do with China. For this session, that was enough to do the job. Ian in Pennsylvania. Ian.
Mr. Cramer, a big old belated pumpkin spice booyah to you, sir.
Never too late for that one. Never too late. What's up?
Called about American Eagle Outfitters. Ayo. Get it? Ayo.
Yeah. Good call there.
Sorry about that. Now, I know you don't love the mall space, but these guys have a great online operation. Just came second place. Piper Jaffray Teen Survey, both for apparel and places to shop online. Only beaten by Amazon. But the stock's been absolutely beaten down this year. Currently trading at nearly yearly lows, but it's a solid dividend stock with price to earnings under 10, and with tailwinds from back to school this quarter and holiday shopping coming up. Do you think this is a good sleeper pick right now?
Look, Ian, it could be a trade, but I got to stick by my knitting. You know what it is. It's watch time. Walmart, Amazon, Target, Costco, Home Depot. And if I ain't watching, I ain't buying. Let's go to Ali in Hawaii. Ali.
Aloha.
Aloha. Mahalo.
Jim, I had a question for you. Occidental Petroleum. Two behemoths fighting each other, Icahn and Warren Buffett, trying to achieve the same goal by shareholder value, paying 8% dividend. In your opinion, is it a good buy?
No.
And keep accumulating for a couple of years?
The company is paying 8% to Warren Buffett. He certainly has, let's call it first dibs versus the dividend. I don't like the oil stocks. I don't like fossil fuels. I don't like Occidental. All right, there's major rotation underneath today's action. The winners are immune to the fallout from the trade war. And that's all it took to do the job. Mad Money tonight. Mark Benioff says capitalism is dead and needs a reboot. So what's his plan? I'm talking with the visionary Salesforce founder. Then United Healthcare sparked a rally for the market yesterday when it reported. But what can its quarter mean for the managed care sector? I'm investigating. And it's an under-the-radar fintech player that could be worth considering. I'll reveal the name. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.